Helen, most people think a mortgage is just about credit and income, but many still get rejected. What are the hidden pillars lenders are actually looking at to decide if someone is truly mortgage ready in Canada?
How you qualify for a mortgage in Canada is very different from most other places. Because Canada is heavily regulated, the banking system and the financial sector is very heavily regulated by the government. You have two types of way to qualify. You can qualify at the bank or you can qualify with a mortgage broker. The difference is that there's a higher chance that a mortgage broker will get you qualified for more than at the bank because the bank has to fit you into their rules. So it's not that they don't want to, it's that they have to fit you into a specific threshold of risk tolerance. And if you are considered too high risk, which newcomers, people who are new to Canada, they tend to be high risk, right? Because you're new here, you might be on a work permit, you might not have a stable job, or you don't have enough credit history. Those things are the things that we look at to consider whether you're high risk or low risk for a mortgage. Why? Because a mortgage is probably the biggest loan that you're going to get. And I think it's a good thing that we have these restrictions to help you purchase the house and make sure that you are qualified to buy a home and to be responsible enough to carry a mortgage. So when you qualify for a mortgage, there's several factors that we look at. You're looking at your income. Now we look at gross household income for the family. We don't just look at one person. We try to use everybody's income. So if you have a full-time job or a salary job, or if you're working part-time, there's different ways to use that type of income to qualify you. And then the other thing that we look at is your credit history in Canada. So if you're a newcomer to Canada, what I always say is you want to start building your credit because in Canada, your interest rate, what you can borrow, how much money you can borrow, and your future wealth is really based on your credit history, your credit score, and your ability to repay your debt. So those are really important things that people don't really consider because it's not very common in other places, even United States, where we are so close to them in the financial sector and by rules, they have a completely different set of rules for credit history than we do here. And so I always say credit is very important. As soon as you come to Canada, you know you're going to stay here. You want to establish two trade lines. What is a trade line? That is one credit card or two credit cards or a credit card and a cell phone plan, something that is going to go on your credit bureau that is going to continue recording. So any type of credit cards, cell phones, monthly plans, vehicle payments, that is going on your credit bureau, and any bank will be able to see how you are repaying that. Are you responsible? Do you pay that off monthly? Do you go over your limit on the credit card debt? And that determines your interest rates for everything in Canada, your credit cards, your mortgages, even your vehicle financing. If you're not responsible with your credit cards, if you're not responsible with your debt, you're most likely going to get really bad interest rates or you're not going to get anything at all. I do think it's a very good policy personally. And I feel like I got a little bit off topic. So that portion is good for the credit. Now, that is probably the most important thing that I will say to anybody is as soon as you come here, establish your credit. Because if you don't have established credit, you have to have more money for down payment, or you have to live here for at least 12 months. So the minimum down payment you need to qualify for a mortgage in Canada is 5%, whether you're on a work permit or you have a PR or you're a Canadian citizen, you have to have at least 5% down payment. Now, if you're a non-resident, which means that you do not live in Canada, you do not pay taxes in Canada, and you want to buy here, you need 30 to 35% down payment. So that is completely different. But I think we're talking more about people who want to live here and people who are trying to either establish themselves in Canada with a work permit or a PR. For that, you either need 5% down payment or 10% down payment. And that is based on the purchase price. So if your house is $500,000 for the purchase price, you need at least 5% down payment. And then we look at, do you qualify under the 5%? So have you been establishing your credit for a minimum of 12 months? Have you lived here for a minimum of 12 months? If you have, that's perfect. Then you can use the 5% down payment. And how we look at that is your credit bureau. We see, okay, you have 2 credit cards, or you have a credit card, a cell phone bill, or car payment. You've been paying them off every month. You've never missed a payment. You don't go over your limit. And then we look at that and we're like, okay, perfect. You have been repaying it very well. Your credit score, you want your credit score to be above 720, ideally for as a newcomer. A lot of the banks have different limits for credit scores, but I have seen over the years personally that if your credit score is above 720, they consider you much lower risk and put you in a low risk category for qualifying for a mortgage, which as a newcomer, that is where you want to be. Now, let's say you've been in Canada for 6 months and you don't have established credit and you don't have enough credit history here. You could still buy a home. You just need 10% down payment. You need more money because you're now higher risk. You might get different interest rates depending on where you go. Again, what a bank tells you and what a mortgage broker tells you are very different things. And the reason for that is if you go to a bank, they can only offer you their own products. If you go to a mortgage broker, I look at all of my lenders. I look at the insurance policies because you have to qualify under the insurer's rules. We have mortgage insurance in Canada, and as a newcomer, you absolutely have to meet their criteria. So not only do we look at that, we also look at different lenders who will allow you to fit into a different category than a big bank. There are over 36 lenders for mortgages in Canada, and so people think there's only 5 big banks, but there is not. And the majority of these banks are actually owned. They actually own a lot of these other mortgage lenders.
Okay, it's something that I only ask to myself, that if I go with a mortgage broker to get my mortgage, I can access to a private lenders and also with the big banks in Canada. Is that correct?
With a mortgage broker, we work with the big banks. We
Excellent.
work with other monoline mortgage lenders. We have B lenders and A lenders, and some monoline mortgage lenders have better rates and better products than the big banks because they're less constringent to the banking policy and risk tolerance, right? So a bank might say, okay, based on risk tolerance, we can only offer people this interest rate. Whereas a monoline mortgage lender, they don't have the same constraints. So they could say, we could drop the rate to this, or yeah, I know you've only been here for 6 months, but we think you're a good client that will get you a mortgage. So you can always go to a bank and you can get your mortgage at a bank. But I always tell people that if your bank tells you no, come to a mortgage broker, get a second opinion, because there's always something for you. We can always make you a plan. If you don't qualify for a mortgage right now, we might actually have a plan for you to qualify within a month or two. A bank will just tell you no. We will come up with a plan for you to get you to where you want to be as quickly as you can. And we do a step-by-step program for most clients and say, okay, this is where you are. This is where you want to be. Here's a step-by-step program of how to get there, right? We don't just say, oh, you have to work on this. No, we actually tell you exactly what you need to do because we want you to be successful. We want you to have a house. I want my clients to be my long-term, lifelong clients. I want you to be with me until you're retired and your mortgage is paid off, So that's my goal. It's to build a relationship with my clients. It's not to, sell you and get you out the door, because that tends to be what the banks do. And people who work at the banks, they don't work for themselves. They work for the bank and they're salaried and they have to meet a certain quota to sell you certain products. Whereas when you work for yourself and you own your own business, you have to build relationships. So sometimes I will send people to a bank because I'll say, they might have something better for you than I do. Sometimes I will say, well, you don't qualify now, but here's how we get there. And then I'll check up on them. People get surprised that I say, like, I'll call you in 4 months and I'm going to check up on you because I told you to do this. And I'm like, I'm going to call you and we're going to have a chat. And I do. And they're surprised. They're like, oh my God, you actually called me. I'm like, yes, I put on my calendar the day that we talk to call you. And I remember you. And it's always in my mind to make sure you're doing well. So.
That's something amazing because you are always after the client and you are always providing a reliable solution. Thank you so much, Helen, for that. And tell me, what about the income? Is the income important in my process for getting a mortgage? If you are finding this helpful, subscribe now to access our complete series of Canadian mortgages and master your home buying process.
Income is a bit complex. So again, you go to a bank and they will tell you one thing. You go to a mortgage broker and they'll tell you something else. Both are true. How they qualify and how we qualify are very different. So with a bank, you normally they want you to be salaried, or if you're not a salaried employee, you have to be part-time or full-time hourly with guaranteed hours, or you have to have guaranteed income of some sort. The hard thing is for newcomers to Canada is if you have commission income, if you are part-time with no guaranteed hours or even full-time with no guaranteed hours, unless you've been at that job for at least 2 years, the big banks will not qualify you. For brokers, it's also difficult, but at least we have some rules that we can make work for you depending on your scenario to see if we can find a lender that would get you there. But for example, if you own your own business, you have to file taxes for at least 2 years unless you have a lot of money for down payment. But if you want to qualify with the 5% down payment or the 10% down payment, you have to follow the insurer's guidelines and you have to qualify with paying your taxes on your business for 2 years. You have to have positive income. You cannot show negative income. I know you have to write stuff off. You want to write everything off. But at the end of the day, if on paper your business is not making money and you're losing money on paper, even though because you're just writing it off, right? You might show that your business made 100 grand, but if you write off that 100 grand completely, so you don't have to pay taxes, that looks bad on paper. Then you're not going to get a mortgage. No one's going to get you a mortgage because you're showing that you spend more than what you make, right? So that's just a common practice for any lender, any mortgage place, and any business. Even if you go and get a business loan, they'll look at it the exact same way. If you are salaried, that is the most ideal. They want you to be salaried, especially as a newcomer. And I'm an immigrant myself. My family immigrated to Canada 25 years ago. And right now there's an influx of immigrants from my community coming to Canada for a specific reason. And I'm seeing a lot of misunderstanding of what their contracts actually say. So for that, I always say, talk to your mortgage broker. If you're going to take a new job or if you're going to take a new contract somewhere else, call me first because I want to look at the contract. What is happening right now is a language barrier or misunderstanding of what a full-time job is, because a lot of the people that I see are either seasonal workers, so they're not guaranteed work in winter, and they don't know that because they don't understand the contract that they're reading, right? Their boss will say, yeah, you're going to have a lot of hours, which is true, but when you look at the paper, when you look at the actual contract, you're not guaranteed those hours. And that is a big issue that we're running into as mortgage brokers, is that when you sign an employment contract, you're not actually aware of the actual conditions of the income. So you might very well be getting 40 hours a week, but on paper we'll say you're not guaranteed those 40 hours. If you're not guaranteed those 40 hours and you've been at your job for less than 2 years, no bank will touch your mortgage because you're not guaranteed those hours. Your boss can cut you off legally and not give you any hours. And we can't say, well, yeah, you've worked 40 hours for the past year, but the next year you might have no hours. And so it's unfortunate, but that is happening quite a bit right now in Nova Scotia and in Canada in general. So I encourage you to call me, talk to me. We'll look at your income situation and I'll say whether we can use that income or not, because there's a lot of different income situations. And I feel like I could talk about this for hours because there's so many scenarios. One thing I will say on the mortgage broker side is we can use higher income generally than a big bank. We have ways to calculate different types of income. There's different programs through different mortgage lenders. So there's stated income. For example, if you're a self-employed individual, we know that your gross income is 100,000, for example, and you write a lot of it off, but you write it off for a reason because we're being reasonable people and we know that you're writing it off so you don't have to pay as much in taxes. Then we want to add it back. Banks don't really have that program, or most of them don't, but a lot of monoline mortgage lenders offer such a service or such a program. And so, like I said, get a second opinion. If you go to your bank and they say no, go to a mortgage broker, get a second opinion, because again, we will have so many options for you that you're gonna be like, oh my gosh, why didn't my bank tell me that? It's not that they don't want to help you, it's that they can only share their policy with you. They're not going to tell you go to a mortgage broker because they don't know what we offer, right? They don't keep up with other 30 different banks and lenders to figure out what policies they have. They just have their own. They'll say, no, this is how it is, because that's all they know, because that's all that they're legally allowed to tell you.
And what are the common mistakes that people used to make when they are trying to get a mortgage? Is there something that you can say about?
Yes. Do not get a really expensive car loan. Do not get a car loan that costs you $700 a month or $800 a month or even $500 a month. When you're a newcomer to Canada and you have cash, I always say save that cash for a house, because a house is an asset. You want to grow your equity, you want to grow your wealth, you want to grow your assets. A house is a real asset. And in Canada, for the past 20, 30 years, home value has gone up significantly, even though it has dropped slightly in Toronto or Vancouver, which is a completely different topic. Everywhere else in Canada, if you bought a house 20 years ago for $60,000, it's worth $500,000 right now. And most Canadians buy 3 to 5 properties in their lifetime. So you have a starter home, you have your middle home for when you grow your family, and then you have your retirement place, right? And then some people buy cottages, vacation homes, etc. So that is growing their wealth because they know that that's going to go up in equity and in value. When you purchase a vehicle, it is a depreciating asset, and I look at it as a liability, because as soon as you buy a brand new car and drive it off the lot, it loses value. As soon as you buy a used car and drive it off the lot, you lose value. Your monthly payments are really high because interest rates are high. Most people's vehicle payments right now are $600 a month.
Plus the insurance.
Plus insurance, plus gas. This reduces your cash flow. You're significantly reduced on how much you can qualify for a mortgage, because we look at your income minus your debt plus your down payment. If you're paying monthly payments of $600 a month for a car loan, you're not going to qualify anywhere near as much as you want to. So if you're moving to Canada and you want to buy a home and build your wealth here, do not buy a car first, or buy a cheap car for cash, right? It's difficult to say don't buy a car because in this province, it's hard to live without a vehicle. But if you want to buy a home first, and then after you buy a home, you could finance or buy a vehicle and spend money on that. Again, because your home, you're building equity, you're growing value in that house. And in the vehicle, it's a depreciating asset. And on paper, when you're looking at a mortgage application, we put vehicle expense as a liability because it's very much an accounting formatting. Mm-hmm. We have your assets and we have your liabilities, we have your income, we have your monthly debts. That is what we look at to qualify you for a mortgage. This is the biggest mistake that people make. It makes me so sad because I know you have to have a car, but you could literally lose out on a house because of it, right? And then you can't get rid of your loan. You can't pay it off early. You're going to have a penalty fee because the financing companies for vehicles make you pay a penalty fee in most cases. And your loan is so high that you just don't have the cash. Like, why would you buy a $30,000 vehicle if you do have the cash versus putting it down for a house and then financing the vehicle after you buy the house? Like that, mm-hmm. In my mind, that makes more sense because I don't see vehicles as assets, right? Mm-hmm. They normally never appreciate in value. Another common mistake that I see people make is they think that if they have no credit cards and no debt, it means that everything is good. Not in Canada. If you have no debt and no credit cards, you have no credit history. If you have no credit history, we have no way of knowing of your repayment and your responsibility of debt. You're never going to qualify for a mortgage. That's why I say as soon as you come here, get 2 trade lines, get a credit card and a cell phone bill, or get 2 different credit cards. Use them monthly, pay them off every month. I don't know, use one for groceries and then the other one for gas. And another common mistake that people make is if they do get a credit card, they'll use it and then they'll pay it off the same day. Don't do that. Don't do that, because then it doesn't report to the credit bureau. You have to give it at least a week. To post on the credit bureau before you pay it off. Otherwise, it doesn't even show up. So I've had clients come to me and they're like, well, I have the Costco credit card and I always pay for it. And I'm like, okay, but when do you pay it off? Oh, right away. Okay. So it doesn't get reported. Nothing happens. In the bank size, you spend the money, there's no time in between, and you pay it off right away. They don't even report that to the bureau that there's a balance, because a credit balance takes 15 days to post on the credit bureau, right? So within those 15 days, if you pay it off right away, they're not going to see that. Then you're not building your credit.
That's important. And something that you are talking about is only having 2 credit cards. Is that your best advice for credit cards, or you can have 5 or 10 or 1?
It has to be minimum of 2 trade lines. So anything that would be recorded on the credit bureau. So like prepaid phone is not recorded. Like a phone plan is not recorded. But if you're paying for a phone monthly, like a cell phone that you're paying off on a monthly basis with your bill, that will get recorded. If you have a Costco credit card, or if you have a Tangerine or Triangle or whatever bank credit card, I would say at least 1 credit card. I always have 2 trade lines to build my credit, but it doesn't have to be a credit card. It could be something else. I don't see a reason to have multiple credit cards, because you're supposed to pay them off every month. You're not supposed to run up your credit card and then start using another one, right? That's a really fast way to bad debt and bankruptcies and consumer proposals, which is not a place you want to be. I say 2 trade lines because statistically that is what people recommend and what credit bureaus recommend to establish your credit, right? So you could have 1 monthly recurring payment like a car loan or a cell phone, or you could have 2 credit cards if you don't have that, and then just use one for one thing, one for the other thing. I have 2 credit cards right now. I've never used one. It's my emergency credit card. It has a high balance on it, and if something happens, I have to use it, I'll use it. And then I have my lower balance credit card that I use for everything. So I go grocery shopping, whatever I buy, I pay it off every month. Do not exceed 60% of the limit. So if my limit is $10,000, I don't really go over $5,000-$6,000, and then I pay it off every month because I know that it will build up my credit. So right now, my credit score, to have a good credit score is 800 or higher, right? My credit score is in the high 800s because I follow this rule. One thing that I want to say about credit scores is if you go to a bank or you go to anywhere to get financing, car loan, cell phone, they do a credit check on you. Sometimes they don't tell you what that is. A credit check is to basically get a report from the credit bureau company to see your repayment history. Every time you do a credit check, it is a hard hit on your credit. And what that means is whatever your points are, they go down slightly. However, if you're applying for a car loan and you go to 3 or 4 different dealerships and they all do a credit check within the 15-day mark, it only counts as 1. But if you do one this month and then another one in next month, those are all separate points and that drops your credit score. So you want to make sure that you don't do a hard credit hit too much. Yes, it will recover over time, but it takes at least a month to get back to where it was. So for example, I purchased a property in October, and then in November I get a report that my credit score dropped slightly, and it dropped by 10 points because I did 2 credit checks, one with myself, one with the lender. The bank did their own, I did my own. That is how they work, and they were in separate months. One was in October, one was in November. So it was quite a big credit hit because it was done over 2 separate months. Had I done them both at the same time, it would have just counted as the one credit hit, right? So if you do a credit check within 15 days, here, wherever, different banks, they won't come as multiple credit checks on you, and they won't drop your credit score as much. But if you take time and you do one here and then one there every other month, then yes, that is going to drop your credit score really quickly. You want to pay attention to that. You want to either sign up for, there's apps like Borrowwell, which is free, where you could see what your credit history is, what your credit bureau is, and you can keep up with that. Or you could sign up with Equifax or TransUnion. Those are the 2 main reporting companies that Canada uses for credit history and trade history. So you can sign up with either one, but I believe for both that they are paid for, and that you can only get a free report once a year. So
Thank you so much, Helen. And what is the best place for contacting you? Can you share with us your phone number, your social media, where people can be in touch with you and get more information about these mortgages and credits?
Absolutely. You can contact me on my work phone at 902-237-1112, or you can look me up. It's Gonda Mortgages or Helen at gettheidealmortgage.com.
You know now what lenders look for, but being approved doesn't mean you can afford it. Click here to see how to calculate your real budget without breaking the bank.